Hello students, this is Punjika Rathi, Assistant Professor in IMS Engineering College, Ghaziabad. Today I will be talking about the market structures, the competitions in the market, and I will be briefing you about the perfect competition and the price and the output determination in the perfect competition. So, let us start with the concepts. These concepts are in unit number 4. So, first we should know what is the meaning of market. So, market is the arrangement where the buyers and the sellers are interacting with each other to buy and sell the product at a agreed price and for a price, and they want to satisfy their needs. Yes. So, it can be a place, it can be a phenomena, or it can be some arrangement in which they are dealing, they are interacting. It can be physical one, it can be virtual one. The characteristics of market, how the market is, we can define different markets on the basis of the competitions, how much competition is there in the market and how many players. The competition is defined in the form of the in the number of players. The competition is dependent on the number of players in the market. The nature of product, what kind of product is it a luxury goods, luxury product, or durables or non-durables or necessary product. That also defines the how much the competition would be, whether it is a protected industry or not. The number and size of the buyer, what is the size of the market. So, as per the size of the market would be characterized. How much there is freedom to entry and exit, it means there are there some barriers or not, or there are interventions of the government or not, or the government policies which they are regulating, like how many players can enter or can exit the market. That defines that what kind of market is. So, market is characterized by number of features, and these features describe the characteristic of the market. This characteristic of market is defined as the market structure. So, what is market structure? Market structure means the characteristics and the level of competition in the market. Market is generally for a product. Market is generally for a product. So, we say for different products there are different markets. So, here the market is synonymous to industry as well. Here in economics the market is synonymous to a industry, because we are saying the market is related to a particular product. And what a industry is? Industry means the number of sellers are selling similar product, it is for a particular product. For example, automobile industry is one market, pharmaceutical industry is another market, telecommunication industry is different market, financial services is a different, altogether different market. So, there are different markets, and how the characteristics of each market are, that is called as the market competition or market structure. So, if I ask you what are the features, what are the characteristics on which we are able to define the market, these are the features, these are the characteristics on which we are able to discuss the market. So, let us move ahead. The topic of this lecture is market competition. So, focusing on that competition is, what the competition is. Competition depends on the number of players. On what factor depends? The number of players in the market. How many numbers? So, as the number increases, competition also increases. Number of buyers as well as the number of sellers. The competition depends on the buyers as well as the sellers. It depends on buyers as well as the sellers. The type of the product, what kind of product is? If the product is regulated one, there would be no competition. Product is unregulated one, there would be high competition. The product is having huge profit margins, there would be more competition. Product is having less profit margins, there would be less competition. The price of the product, who can decide the price? Whether the seller has the control on the price, there would be more competition. If the seller has no control on the price, there will be less competition. So, the pricing has an impact. Knowledge about the market, do the sellers and the buyers, do they have the adequate knowledge of the market or the perfect knowledge of the market? Then again defines the competition. If they have perfect knowledge, there would be huge competition, perfect competition. If they have no knowledge, there would be imperfect competition. Then barriers to entry and exit, like new player are they being able to enter the industry or not? If they are being able to industry, it means there would be huge competition, because anybody wants to enter the industry, and it can because of the absence of any barriers. And exit also. So, if there are no barriers to entry and exit, the competition would be high, and similarly huge barriers to entry and exit, the competition would be low. So, this has a positive relationship with the competition. Knowledge is also having a positive relationship with the competition. Pricing, control has, if they have control, there would be less competition, and if they have more control, there would be less control, there would be huge competition. So, this is how the competition is changing in the market accordingly as these features are changing. So, now what are the types of competition? As we have discussed the the criterias of competition, let us discuss the types of competition in the market. What are the different types of competition in the market? So, in the market, the competition is of two types. It is perfect or it is imperfect competition. When we say perfect, let us first start with the perfect competition, because when we are able to understand the perfect competition, then only we will be able to understand the imperfect competition. So, perfect competition, as we say perfect, if we say somebody is perfect, it means that it is having some particular features which are missing in all other people or other variables, other phenomena, other arrangement. When we say perfect, it means it is having some features. Number one point is that it is having some features which is there in perfect competition and which are not there in the perfect competition, the imperfect competition. That is why it is imperfect. The name is imperfect. Here the name is perfect. Perfect matlab it is good from any point of view. Everything is quite perfect for that particular phenomena. So, when we say perfect competition, it is that market structure. These two types of competition, they are also called as types of market structure. So, like if it is asked in exam, what are the types of market structure, we would be discussing the same chart, the types of market structure. That there are two types on the basis of the competition. There are two types, perfect competition and imperfect competition. So, perfect competition is that market structure in which there are large number of buyers and sellers, and they are selling a homogeneous product. Large number of buyers and sellers are selling a homogeneous product where seller has no control on the price. For example, fruits and vegetables market, but we will say that there is no perfect example for perfect competition, because the perfect is a word which is impossible to find in reality. That is why we will say there is no perfect example, but yes, there are examples, there are markets which resemble to perfect competition, but they are not perfect, they are close. They are like, these are the markets which are close, but they are not perfect. So, perfect competition is on the basis of the large number of, we will say there are very large number of sellers and the buyers. What is the product? Product is the homogeneous one. It means there is no differentiation in the product and there are no barriers to entry and exit. These are the basic features of perfect competition. Then we say imperfect. Imperfect matlab any of these point is missing in the imperfect competition. It is again of three types: monopoly, oligopoly and monopolistic competition. So, when we move from very large to one, so there is only monopoly means there is mono means one, there is only single seller. There is a single seller which is selling a product which has no close substitutes. So, that is called as monopoly. When we are saying that there are few sellers which are larger in size, few big sellers are selling a homogeneous or differentiated product, that is called as oligopoly. It means here the seller was, how many sellers were? 1. Here the sellers are few, but they are larger in size. They have huge size, means they have a huge scale of production, they have captured the huge market. When we say monopolistic, monopolistic means there are large number of sellers, but this large number is less than the perfect competition. There are large number of sellers, they are selling the differentiated product. What kind of product they are selling? Differentiated product. So, this is called as the monopolistic competition. Very large number of sellers, large, few, 1. Product is homogeneous, means no differentiation. Product is differentiated. Product can be differentiated or not differentiated. Product is such that there is no close substitute. Seller has no control on the price, seller has some control on the price, control increases, and the seller has a full control on the price. Here no barriers to entry and exit, barriers are increasing and highest barriers to entry and exit. So, this is how, if I plot them on a continuum of increasing or decreasing the features. So, at one continuum there is perfect competition, and the second continuum there is, in the last corner there is monopoly. So, here the number of sellers would be rising, increasing from going from this to decreasing, going from this to this side, the number of sellers are decreasing. This is how the differentiation in the perfect and the imperfect competition. So, moving ahead to, first we will discuss about the perfect competition, then we will move ahead to these different types of competitions. So, what is perfect competition? As I have already described, that perfect competition is the market structure where there are large number of buyers and sellers and they are selling homogeneous product. So, what does it mean? It means that there are large number of buyers and sellers. The meaning is that the number, if I ask you how many sellers, it is such large that no single seller can change the market supply, and the buyers are also such large that no single buyer can change the market demand. Homogeneous product, it means that there is no differentiation of product. It means no buyer can identify the seller of the product by looking at the product itself. It means I got a product and I am unable to identify who is producing that product. For example, fruits and vegetables. You see the fruits and vegetables at different stalls and you are unable to identify that who has produced it, because there is no differentiation. They look very similar, exactly similar. That is why we are saying there is no differentiation. There is freedom of entry and exit. It means there is no barrier. Why there is freedom of entry and exit? Because there is no barrier to enter and exit. Means there is no restrictions, no government regulations are there, no government restrictions are there related to entry and exit. There is no cost related barrier, there is no volume of production related barrier. Then it means anybody can easily enter and exit the industry. The perfect knowledge, the buyers and sellers, they have the perfect knowledge of the market, they know everything about the pricing, about the supply, about the availability of the product. The perfect elastic demand curve. When we say demand curve is elastic, it means the price elasticity of the perfect competition is equals to infinity. And if we can recall, how was the demand curve when EP was infinity? The demand curve was a straight line, horizontal line, which was parallel to the x axis when we have taken Q on x axis and price on the y axis. So, the demand curve in that case, when the EP was infinity, it was a straight parallel line parallel to the x axis. So, this is how the demand curve looks in case of the perfect competition. Like if a question is being asked, like what should be the shape of the demand curve in case of perfect competition? So, you will answer it is a straight line which is parallel to the x axis. straight horizontal line. Here the seller is a price taker. Price taker means that seller has no control on the price. So, if I ask you, because we are saying that seller has no control, so who determines the price? How the prices are determined? In that case, we will say that the prices are determined by the forces of demand and supply, and how the demand curve is falling downwards, supply curve is rising upwards, and how the prices are determined by the interaction of the demand and supply, which we have discussed in the market equilibrium segment of unit number 2. So, the market price are determined by the demand and supply forces, and it is on the basis of demand, market demand and supply. So, if market demand and supply are changing, the market price would also be changing. So, seller has no control on the price, and similarly buyer has no control on the price. Seller is called as the price taker in the perfect competition. There is perfect mobility of the factors of production. It means the factors of production are perfectly mobile, they can move from one seller to another seller. There is no government intervention, it means that there is no restriction on entry and exit, kind of barrier, there is no barrier. Then to discuss the profit and output determination in perfect competition, we need to understand that how the profits are determined and how we say in economics that what kind of profits are there. So, there are three situations of having the profits. A seller can have supernormal profit, normal profit and supernormal loss. When average cost is less than the average revenue, if this is the condition, there will be supernormal profit. How we analyze the profit? When the revenues are greater than the cost. So, this is the situation, which is very general situation. Normal profit, when average cost is equals to average revenue, this situation is called as a break even point. It means that there is no profit actually. Normal profit means there is actually no profit, no loss, that is called as break even point. Supernormal loss, when average cost is greater than average revenue. So, it means that this seller is having losses. Here in economics, we call it by supernormal loss. Then we need to understand what is the condition of optimum output. So, these are two conditions of optimum output, that MR should equals to MC, marginal revenue should equals to marginal cost, and second condition is that marginal cost should intersect marginal revenue from below. What does it mean? It means that if it is the marginal revenue, here is the output, here is the cost and revenue on this axis. So, if this is the marginal cost, so marginal cost, suppose it is going like this, marginal cost is going like this, and there are 2 points A and B. So, the condition number 1 is there at point A and point B, but as per the optimum output condition, we need to find out these two things at the same place or same point of time. So, condition 1 is saying that MR should be equals to MC. So, at at A and B, both the points, the condition 1 is fulfilled, but condition 2 is saying that marginal cost should intersect marginal revenue from below, and it is fulfilled at point number B. So, optimum output would be equals to OQ, and how we have determined? By applying these two rules. So, whenever we need to calculate the optimum output for the seller, we will be using these two things. We need to ensure that the marginal cost should equals to marginal revenue, and marginal cost should intersect the marginal revenue from below. So, to determine the price and output for the seller in perfect competition, there are three situations. One is called as under very shorten, very shorten. So, very shorten is that time period in which no seller is able to adjust its supply. It means the demand and supply, they remain constant in that situation. It is a very short time period, maybe a day's time, because in day's time the seller cannot adjust the output whatever he wants to sell in the market. For example, the quantity of fruits which a fruit seller is having at his stall, it would remain constant for that day, and he cannot change it in that day, it will remain same for that day. So, how the prices are determined for that day only, that is called as very shorten. So, how the prices are determined? This is the market and this is the seller. So, how the market price is determined? By the forces of demand and supply. So, what will be the equilibrium price? This line is indicating the equilibrium price where the demand and supply are equal, and what price seller has to take to sell the product? He has to take the same price which is determined by the demand and supply forces. So, this is the price, means the price is 7 rupees. He has to sell the product at 7 rupees only, and whatever the seller, the quantity he is having at his stall, he has to sell the whole quantity at the same price, otherwise he will be having losses. Yes. So, this is how the prices are determined in the very short run. Then comes the second situation. If you have analyzed, in the short run he is not able to adjust the output. Why? Because I have already said that the output would remain constant. So, there is no need of determining the output for the seller, because output would remain constant for a period of time, for the short period of time. Then if we are going to find out the pricing in short run, now we should know what is short run. Short run is the time frame in which seller is able to change the supply. He is able to change, but he is not able to shift the supply curve. It means he can only increase the supply by changing labor, but he cannot increase the supply by launching new plants or new ventures, or he cannot go into mergers and acquisitions or into strategical decisions he cannot take in that time frame. So, it is that time frame where the supply would be changed, but only up to a limit. So, how the prices are determined? So, to determine the price, we need to understand one thing, that there is a relation. We need to understand that there is a relation between average revenue and marginal revenue. What is average revenue? This we have discussed in unit number 3. Average revenue is equals to total revenue upon Q. And what is marginal revenue? The change in total revenue by change in the total quantity when the quantity changes by 1 unit. So, what is the relation? If AR is falling, MR would also be falling. The relationship is AR is falling, MR will also be falling, but the rate of fall in MR would be greater than AR. So, it means if AR is falling, MR would be falling, but the slope would be highest in MR as compared to AR. This we have to understand, first thing. Second thing, we need to understand what is the relationship between AR and price. So, average revenue is equals to what? Total revenue upon Q. And what is the total revenue? Price into quantity. So, if Q is cancelled, so it will be equals to P. So, average revenue would be equals to P. And the second relation between AR and MR is, if AR is constant, if AR is same, MR will be equal to AR. This we have to learn, then only we will be able to apply, we will be able to find out the optimum output. So, what we have to learn? The relation between AR and MR, and what is the relationship between AR and price, and the relationship is that average revenue will be equals to the price. Okay. So, for finding out the price and output in the short run, what we do? What are the steps we take? First, we plot these two curves, one for market and one for the firm, for market and for the firm. Here we will take quantity, here we take price and revenue, price, revenue for R and cost for C. So, how the demand and supply forces interact? This is demand and this is supply. What is the market equilibrium price? It will be by the interaction of demand and supply. So, what would be the equilibrium price? It will be equals to OP, here it will be equals to OP and it is the price. And what is the relationship between price and AR? As we have discussed that it will be equals to AR also, price equals to average revenue. So, this price is actually, this price line is what? It is the average revenue line for the seller. Okay. Now we have to plot. So, first we have determined the market price, then we have plotted the average revenue, then we will plot the marginal revenue and marginal cost. As I have said, if AR is same constant, the MR would also be same, it means this line is also equals to marginal revenue for the seller. Yes. Then marginal cost, we have discussed in the unit number 3 that marginal cost would be a line which is a it is kind of this line, marginal cost. Okay. So, the point where marginal cost and marginal revenue are interacting, that line would be going to give us the optimum quantity. At this line we have to compare two things. What we have to compare for this quantity, OQ will be comparing two things, average revenue and average cost. So, let us see how we plot this in the coming chart. So, what we do? We plot these things. In this chart we can see this is the average revenue determined by the interaction of demand and supply, as we have discussed earlier. This is the marginal cost, J-shaped curve, this is the average cost, this is the average cost of the seller. So, how the optimum output is determined, where MR is equals to you can see how MR and MC are intersecting. So, that gives the optimum output. So, this is the optimum output, and for this producing this quantity, how we have to compare average revenue and average cost. So, this line, this whole line is actually this was the average revenue, this whole line, and this line, if we denote by this zigzag line, this line is the average cost line. So, which is greater, average revenue? So, average revenue are greater, it means this is the profit, this is the profit. So, if we take this area, this becomes the total profit available to the seller. So, because AR is greater than average cost, so there are supernormal profits. This condition is supernormal profit. So, how we have derived this? By comparing average revenue and average cost. So, a seller may have greater average revenue, or it may have average revenues, equals to the average cost. Here at this point, average revenue is equals to average cost. So, it means there is no profit, no loss, or it may have average cost greater than average revenue, then he may have losses equals to this shaded area. So, it depends on the profit situation of the seller, he may have any of these situations, losses or profits. What happens in the long run? In the long run, what happens is that in long run, because of the interaction of demand and supply, when the seller is having supernormal profit, the new sellers will enter the industry and they will take up the whole profit, and the profit margin will decrease, the market supply will increase, and that is why the equilibrium price will decrease, the profits will decrease. So, they will reach to a condition where average cost, long run average cost is equals to the, this is long run marginal cost. So, they will reach to a situation where average cost and average revenue would be equal, and there will be, this is the price line, there will be the quantity line. So, in the long run there will be only normal profits, in the long run. Why? Because of supernormal profits, new players will enter the industry because it is long run, and because of the when they will enter, the equilibrium price will reduce, and then the existing players will have losses, and because of the losses, existing players will leave the industry, they will, means those who are not able to adjust, they would leave, and again there will be increase in demand and decrease in supply. So, prices will increase, and in equilibrium it reaches to a level where there is no profit, no loss, there is no profit, no loss for the sellers. So, in the long run there are only normal profits in the perfect competition. So, this is how the price and the output are determined in the perfect competition. So, examples are stock market, fruits and vegetable market, fish market, I hope the pricing is clearly visible and stable. Thank you, and be happy, be safe.